Hello dear viewers, hope you all are doing good. Welcome to Zenzi Education, where we explore everything commerce. I am Shana Kwad, help you to make your concepts easier. And today I am back with the chapter 2 for KSET preparations, that is accounting and auditing. So, what do you mean by accounting? The very first term that we will be looking into this chapter is only about accounting, and then we will jump on to what is auditing. Now, first of all, what is accounting? Accounting is nothing but a process, a detailed process. A process of what? Recording the monetary transactions. Next comes classifying. So, what do you understand by classifying? Classifying is nothing but differentiating the transactions of same nature under similar head. So, classifying is nothing but grouping of grouping of transactions under the same head. With the transactions which are of same nature, you group them under the same head. Next comes summarizing. So, under the process of summarizing, what do? We prepare financial statements. So, which are the three main financial statements that we look into is balance sheet, profit and loss account, and cash flow statements. Correct? And then, based on what we have summarized and prepared these financial statements, the final step that we look into is interpretation of financial data. So, interpretation of financial data. We come to the conclusions. Conclusions based on various categories or parameters for what we are referring this accounting information. So, we also know there are two users of accounting information. Right? One is external and the other one is internal. So, who are these external users of accounting? Are someone who are outside the organization and are still interested in the accounting information of your business. For what? Maybe for investment decisions. To know if you like your suppliers, like whether to lend you loan, whether to lend you the goods on the credit, they use your accounting information. Correct? There are governments who government to know whether if what are your tax implications, whether you are paying your taxes regularly, to understand in which tax bracket do you fall. Then the external users. Internal are your employees, is the management or the owners who are using this accounting information for decision making purpose. So these are the two important users of accounting, and this is nothing but a process which involves a simple process and steps with the help of which we can prepare financial statements and interpret the result and come to a conclusion. Now, there's another thing also known as bookkeeping. Bookkeeping, as we come across the word, it's very easy to understand, is nothing but recording of transactions. Again, it is recording of day-to-day transaction. Up-to-date transaction is nothing but bookkeeping. Again, you can categorize it as two types: single entry and double entry. In single entry, we refer it as used by the small businesses where they just refer one side of the transactions, whereas double entry transactions are the transaction which are the complete transaction and which record both debit and credit transactions. So double entry transaction and single entry transactions. And also single entry transactions are known as incomplete records and is usually preferred by the small business owners who have no much transactions to look into. They only prepare their cash book and nothing much to worry about. But Under double entry system, they prepare they record both the transactions of debit and credit and prepare complete books of records, have complete records of financial data. So this is nothing but bookkeeping. Now let's look into the different accounting concepts. So accounting concepts. What are these accounting concepts? Are nothing but principles or postulates that guide or help in preparations of financial statements. Very one important thing here is GAAP, GAAP, which is elaborated as generally accepted accounting principles. Why do we have to follow these principles to maintain our financial transaction? Is that it helps us to compare the transactions with one organization with the other organization, or it gives us a standard format on how to present our information, because there are various users of information. These users should be reliable on that information. When we follow such formats or when we follow such principles, it would be easily understandable and also credible for these various users of accounting information. So accounting concepts are nothing but some principles, rules or postulates based on which we have to maintain our accounting information. Very first accounting concept is nothing but business entity concept. So according to this concept, it states that the individual and the business are two separate bodies, are two separate entities. You cannot refer owner as a business or business as a owner. For example, my personal transactions I cannot record in my books of accounts of my business, or business transaction I cannot maintain it as my own transaction. For example, if I give you here is owner invests capital in the business, correct? For that capital, he earns interest, correct? Interest on capital. Owner draws money from the business, we refer it as drawings. For that drawings, he has to pay interest on drawings. Why do we do it? Because both the parties are different. We cannot refer them as a single entity. Both have their separate identities. Business is different from the owner, owner is different from the business. That is business entity concept. Next comes going concern concept. What do you mean by going concern? It means that when I'm establishing a business, I'm not establishing with the motto of that I'll just undertake this business for 2 years or 5 years. When I'm establishing it, I plan it, or I don't plan only like how many years do I want to run this business, until and unless I have some limited scope or limited idea of the business. Like once the motto of the business or once the intention of the business is fulfilled, I can shut it down. But unless and until we assume business is what? Continuous and long running or going business entity. So going concern concept. And with that, we also have historical concept, which means that we record all the data on past information. All the past information is recorded. The transactions are recorded based on past information. So historical concept. There also comes as dual aspect concept, which means that every transaction has twofold effect. Twofold effect. We know that equity is equal to assets minus liabilities. So this concept states that twofold is nothing but debit and credit. Every transaction has two effects. Next comes revenue recognition concept. So according to this concept, transactions should be recorded or recognized when you have earned it, regardless if you have received the cash or not. You have to record the transaction when the service is rendered or the goods is sold, irrespective of revenue is cash is received or not, is revenue recognition. Point of sale is revenue recognition. Then comes accrual concept. Again, transactions should be recorded when occurred, when they are occurred, irrespective of cash is paid or received. That is accrual concept. Next comes consistency concept. What do you mean by the word consistency? It means following the same principle throughout. Today you followed one principle and maintained your books of transaction according to that. Tomorrow you will follow one more principle and maintain your transaction. It becomes very irrelevant information. So consistency principle is nothing but follow or be consistent in following the same methods for preparation of your financial statements. Next comes conservatism concept. So any potential uncertainties or risk, if you see any loss is going to happen, you should record it well in advance. Record it as soon as possible. But for the revenues, should be recorded when it is actually rendered or received. But for conservatism, uncertainties or risk, when you find it's going to happen, it's a potential uncertainty or risk, record such risk or uncertainties is nothing but conservatism concept. Next comes margin concept. This concept states that expenses of that period should be matched with the revenue of that period, is nothing but matching concept. Expenses should be matching with the revenues of that particular period is matching concept. One of the very important concept is monetary concept, monetary unit concept, monetary transaction concept. According to this, you have to record transaction which can be expressed in terms of money only. All the things which cannot be measured in terms of money are not recorded in our financial statements. Because of why? Because of this concept, monetary concept. It records only the terms, or it records only the transactions which can be recorded in terms of money, monetary value, which has monetary value is nothing but monetary concept. Next comes full disclosure concept. According to this concept, the very name only suggests that your presentation should disclose the full information of your business on your financial presentation, on your financial preparation, on your financial statements. True and fair value and full information should be disclosed in the financial statements. It's given by the full disclosure concept. So this was about different accounting concepts. Why do we have to prepare it? How it is undertaken? Because of generally accepted accounting principle, which makes it easy to compare, to study, to rely on that information. And these are few of the accounting concepts. So if you have any queries related to this video, you can post down in the comment section. I'll be happy to help you out. and soon we'll be uploading for the next concept related to the KSET Commerce on the accounting and auditing video chapter 2. So stay tuned, and if you have not yet subscribed to the channel, please subscribe, hit like and share this video with all the KSET aspirants. Happy learning.